This is what the air traffic map for Australia looked like before it went to lockdown in March. And this is what it looks like since April to now. So it's no surprise that travel stocks have taken a beating since most passenger planes were grounded and borders closed. But in a year or two's time, there's no way that people will still be staying in their own countries and things will almost certainly return back to normal. Since even now we're hearing more and more whispers of travel restrictions easing, today let's go through 8 of the biggest travel stocks on the ASX that's set to benefit when we inevitably open our borders. I ordered this by market cap from smallest to biggest. So first up is Helloworld Limited with ticker HLO at market cap rank of around 400. For the old timers, this used to be their jingle.
We're Harvey World Travel, we're the travel professionals.
That's right, they've rebranded themselves from Harvey World Travel. If you don't know what that's about, it was an ad that always played on TV back in the 90s. This is a travel booking agency in direct competition with Webjet on the retail side, but also caters to corporate and government customers. It has experienced increasing revenue and operating margin for the past 5 years and positioned well to recover. Its net profit is decent, though the graph looks a bit lopsided because in 2015 it wrote down $205 million loss due to goodwill impairment, which isn't a cash flow liability, but does cause it to dwarf the actual profits for the following years. Helloworld is 15% owned by Qantas and has survived this year by standing down 75% of its workforce. It carries a debt to equity ratio of about 18%, which is fairly healthy for its industry, and it has a 25% share price increase remaining before returning to its February price. I'd rate this a hold until next year if you already own this, or a buy if you're willing to take a minor risk since there are so many competitors in this space, many of which are overseas companies eating into the Australian market. The second travel stock at market cap ranking of 300 is Virgin Australia Holdings, including Tiger Air. They're currently in voluntary administration and looking for cashed up buys to take on its massive $7 billion worth of debt. Granted, it mostly comes from its depreciating assets of the fleet, made worse by the grounding, but gosh, its financials are absolutely shocking. Just look at those long bars of net losses every year for the past 8 years. I struggle to understand why there are actual bidders willing to take on that debt, but for us normal retail investors, this is definitely one to stay away from. It will take a miracle to turn this business around, but apparently either Cyrus or Bain Capital believes Virgin can become profitable within 3 years by transforming it into a smaller mid-market operator. But I'm still rather skeptical and I think Virgin will struggle behind Qantas' shadow. I rate this stock a short-term hold until a successful buyer emerges if you still hold this stock, otherwise it's definitely a no-go. Number 3 on the list and number 190 on the market cap ranking is Corporate Travel Management, CTD. They are a market leader in helping corporate businesses and government agencies with flights, hotels and rentals. Straight after we looked at Virgin, this is a very safe and viable business to be in once the lockdowns are lifted, and their share price right now is still a great buy considering their exponential profit growth year after year for the past 10 years. The company has very low debt of only 7% of its equities, plenty of healthy cash reserves, and have cut costs to less than half to weather the current storm. Once that storm passes, the stock price still has room for 30% increase to return to its February price. I rate this a strong buy and a worthy stock for a long-term hold. With an EPS of 84 cents and a DPS 40 cents, it will also provide good, consistent dividend payouts that's set to increase every year. Number 4 on our list, and number 180 on the market cap ranking, is Webjet. This has been a very highly traded share based purely on speculation, so let's see if its actual financials are up to scratch. Surprisingly, it's not bad. Net profits have been increasing, and except for 2019, its revenue has been exponential. In 2020, its revenue is expected to drop off a cliff to less than 20% of its expectations, but should return to normal by 2022. If that means that the share price will return to February prices, then it's not unreasonable to expect a 100% increase in 2 years' time. The only worry is if customers are happy to continue paying their $30 booking fee when Google flights do the same thing for much cheaper. I do think that as customers get more tech savvy, their more expensive offerings may affect their revenue figures. I rate this as a short-term buy for the 2 years and to sell when travel returns back to normal. I don't see Webjet emerging as a market leader, especially when companies like Expedia and Trivago offer much cheaper options. Number 5 on the list at 150 market cap rank is Air New Zealand. It has been consistently rated as one of the safest airlines in the world, but its profits have been falling for the last few years, which is a bit worrying. Nonetheless, its share price has shot up on the back of the announcement that New Zealand has removed all restrictions except international flights. We'll expect to see another price pump once Australia-New Zealand travel bubble is announced, and a final price pump sometime next year when international flights resume. This means we can expect about a 50% price increase once things are back to normal. As with all airline stocks, AIZ has a huge debt-to-equity ratio of 150%, making it very easy to have a couple of bad years and be in trouble. This is another stock in the buy and a short-term hold category for me. At number 6 and 100 market cap rank is the bricks and mortar travel agency Flight Centre. Whilst its financial health is quite good, the cost of renting out real estate space is increasing every year, and that eats into its operating margin. During this shutdown, Flight Centre has closed half of all its stores and is running on only 5% of its usual turnover. This is a big red flag because its revenue is tied to its store presence, and if that's cut in half, so will its revenue. But its expenses are not necessarily cut in half as well, because they still need to pay the interest on their debt, which remains the same regardless of how many stores that they have. Flight Centre have a huge 150% price increase remaining because shareholders have been worried about their business model. If they are ever able to return to February price, which does seem pretty unlikely for at least the next couple of years. Whilst the company does have very low debt, it also has almost no revenue for this year, so we won't be expecting any dividend payouts until next year. I rate this a hold if you already own it, and to look at other options if you don't. At number 7 on the list is Qantas, which is one of the world's most profitable airlines after a major transformation program costing them $2 billion in 2014. As a result, Qantas has been able to maintain its profits over the next 5 years, and the current share price is a bargain for what it could be again once flights are resumed. Domestic flights have always been more profitable than international ones, and we'll see a big comeback in share price as soon as the announcement is made that these flights can restart. Qantas has a 25% stock price recovery remaining to return to its February prices, and either the domestic or the Trans-Tasman flight bubble will trigger this recovery. Even though Qantas has a typical industry debt-to-equity ratio of 150%, I do rate this as a strong buy, based on the fact that Qantas has almost an absolute monopoly over the Australian market, and it will be extremely difficult for another viable competitor to emerge. Finally, at number 8 on the list are Sydney and Auckland airports, which I'm going to lump together because both are the country's major airports obviously, but also have very similar financials, stock price movements, and investor sentiments. Both are very safe businesses which won't be allowed to go bankrupt by their governments, and even though Sydney Airport has announced no dividends will be paid this year, both are still strong and consistent dividend stocks to hold for long-term investments. Once flights are allowed to restart again, both will come back leaner and more efficient, which will increase their net profits, which have consistently increased year after year anyway. Both of these stocks are strong buys to hold forever. And that's the main players in the travel sector on the ASX. These stocks will all benefit from domestic travel, which is estimated to resume in September, as well as the Trans-Tasman bubble estimated in October. But that's only if both countries are able to control the infection numbers, which, at the time of recording this video, are still reported to be flaring up every now and then. Even New Zealand is looking at potential infections with a couple of people returning from overseas that didn't get tested first. And more recently, there have been double digits of cases in Victoria that could delay travel even further. We also need to keep an eye on the state of affairs overseas as well, because international travel is the final road to recovery. All of this just means that we need to pick a suitable entry point to ride the recovery process upwards. When will that be? Well, no one knows, but fundamentally our picks remain the same. So even though those stocks are still at the mercy of the Rona, if you can hold on to them for at least the next 6 months, you'll be better off. Thanks for watching a slightly longer video than what I normally make. What stocks are you planning to buy from this list? Leave your picks below and let's see if it all plays out as expected. Don't forget to leave a like below if you want more topics like this, and I'll see you in the next video.